Hello, everyone. Today on the Final Bar, we'll be catching up with Chris Ciovacco from Ciovacco Capital in Atlanta. He always does a great job of bringing a proper long-term perspective. He's going to share with you a very long-term chart, helping you understand this current pullback and how that relates to previous pullbacks, particularly in the NASDAQ. Growthy parts of the market certainly getting hit yet again today, with technology down pretty significantly, down over 2%. The NASDAQ 100 down almost 2.5%, while energy all is well, up almost 4%. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very foggy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of technical analysis, using the technical toolkit to try to better understand what's happening around us as investors. It is a choppy phase, and at the very least, this is a choppy, uncertain phase. At worst, it is a distributive phase, and we've seen plenty of distributions so far. The S&P down over 10% off of highs at the beginning of the year, eclipsing the steepest drawdown that we saw in 2021. What concerns me is this is how the beginning of much deeper pullbacks can actually appear, right? We're right at that sweet spot where this could be the buyable dip, even though, again, more severe than what we saw last year, but a lot of similar conditions with sentiment indicators going very negative, breadth conditions going deteriorating very quickly. However, my concern is that when you look at when the S&P has been oversold, like it has been here this week, it looks similar to previous brief pullbacks, but also looks very similar to the beginning of things deeper. I'm thinking like late 2018, even early 2020, had a similar feel on that first leg lower. So it's all about staying diligent, and I would say focusing on key support levels, particularly in your portfolio. I'm reminded Ned Davis at a dinner years ago said all large losses begin as small losses. I think that's a really important one to keep in mind right now. We have great guests on the show. I'm excited to talk to Chris Ciovacco here in a few moments. Later this week, we have some other good guests as well. Coming up, let's see, tomorrow, hold on, I'm on the wrong screen. Coming up next tomorrow, we have John Kosar from Asbury Research. That's right. We also have Jeff Huge from JWH Investments coming up on Thursday. The pitch is coming up tomorrow on January 26th. If you go to stockcharts.com/thepitch, you can see all the information about that event. I'll be sitting down with Jay Woods from Drive Wealth, Mary Ellen McGonigal from MEM Investment Research, Joe Rabel from Rabel Stock Research. All will be joining me in a great discussion talking about 5 stock picks each, and then we'll discuss them as a group. You will leave that session with a bunch of tickers jotted on a piece of paper. It's a really good exercise, particularly what's happening right now. Let's continue on with our market recap. We're going to start with a poll, and we asked you recently on our live stream page on stockcharts.com, but also on our social media accounts, know your behavioral biases. Which bias deals with the fact that your investment performance looks better and better in the rearview mirror? And we gave you 4 options. I actually tricked Final Bar Nation this time, which I'm somehow a little bit thankful for because it shows that I still have some things to teach all of you. That's good. Confirmation bias is actually the incorrect answer. 53% of you said that. 10% of you picked up on my made up answer, which is rear view mirror bias, which is not a thing, but I feel like I need to trademark that if I'm getting your attention. Prospect theory really doesn't have much to do with that. When you are looking back and you feel like and basically your mind's ability to make your appearance appear better and better, that's actually called hindsight bias, where you actually start to improve in your mind your own performance. An example is the February 2020 high into the March 2020 low. The further that gets in the rearview mirror, the more you're going to feel like you called the top and you called the bottom and how you traded it perfectly. But if you look at your account or your actual comments or your writings, you'll find you were not that perfect, but your mind sort of makes you feel better and better about painful experiences as they get further in the rearview mirror. So I always talk about that. The key is to keep a good track record of what you're doing, keep a trading journal and stay true to that, and make sure you go back and review what you actually did during periods of market dislocation. This period we're in right now might be one of those really good periods to go back and review down the road once we've all hopefully survived through this period. Let's continue on with our market recap. Another choppy day. Yesterday was incredibly choppy with the distribution in the first half of the day, the acceleration to the upside into the close, and a V-shaped day. A little bit of a different feel to the market today, but you had that same sort of pattern with an early sell-off that ended up reverting, and you once again made it all the way back to the close of yesterday. Interesting today, though, we turned on a dime at 3 p.m. Eastern and actually sold off into the close. So a little different look from yesterday where you accelerated, sort of that FOMO going into the close. Today was more of a, thank goodness we got back to yesterday's close. Let's get out now. And the market sold off there. So the S&P finishing down about 1.2%. The NASDAQ really leading the way lower. And this was very much a value over growth feel to today's session. With the NASDAQ 100, the Qs down 2.5%. The VIX back above 30 today. Other asset classes very quickly. Bonds sold off today, but just a bit, and interest rates moving higher. The 10-year yield not quite above 180, but getting there and going up from around 173 as of yesterday's close to around 178. So continuing to push higher, and that steeper, or certainly the steeper yield curve, but especially yields going higher tends to be good for financials, and you saw that play out today. Gold prices higher, silver lower, so a bit of a mixed message there. We talked about gold, the GLD breaking above previous resistance. I think that's a key theme to think about through the course of this year. Certainly we saw gold really not participate in a meaningful way last year. But overall, you're starting to see that basing pattern breaking above 172, 173 would be even better to sort of complete that rotation into more of an accumulation phase. That's an important chart to watch, and commodities as a whole certainly moving higher. Jesse Felder, by the way, when I spoke with him last, we talked a lot about gold and the bullish case for that for the precious metals. Finally, with cryptocurrencies, a mixed bag for sure. Ether sort of rotating around yesterday's close, weaker earlier, stronger later. Bitcoin actually finishing about at a zero, but it got gotten almost to 37.5 earlier in the day. You can see a lot of red on the list right now, but a little bit of green peppered in there overall. Let's look at a chart of the S&P 500 here just to sort of make sense of things. This is one of those days where the candle or the bar for the day changes rapidly. So depending on when you look at the chart, you can get a very different feel. And it's a good reminder. I think a lot of times you get trapped into looking at the current bar, the final bar during the trading day. Remember, that's an active bar. That's an active session. So the movements will continue to change how this candle or this bar looks. You don't want to draw any real conclusions using bar chart or candle chart analysis until the close is locked in. Once the close occurs, that has sort of solidified what that candle or what that bar looks like. And then you can draw conclusions about the next couple days or beyond. So what's happening here, if you really look at what happened, right, sort of the September, October lows from last year, we talked about those being important around 4,300. This week, they have once again become pretty significant. We've been pretty far away from them for a while, but so far the last couple of weeks have taken us right back down to that 4,300 level. On an intraday basis, we got all the way down to around 4,220, 4,230. But we rotated back above that 4,300 level. So even though we've traded below 4,300 for 2 straight sessions, we've not closed below it. And this is why waiting for the close a lot of times ends up being a very significant meaningful thing. A lot of candle charts, by the way, can look very different. A hammer candle doesn't look like a hammer until you have that rally into the close that pushes the close up near those levels usually. So you want to make sure you lock it in. So a couple days we've traded below support. We've not closed below support. And that would be the indication that support has failed. A close below there and then a follow through. So we haven't really had that yet. We have sold off over 12% off of the all-time highs, just above 4,800 in early January. And so that's certainly a significant drawdown so far. We're oversold for the first time in the last year. It's only happened not too many times, but plenty. If you go back to 2009, you'll find plenty of instances where the S&P becomes oversold. That on its own is not a great reason to buy. Combining that with other indications that suggest to you that we might be at a meaningful support level, I could buy that. But just because the market or this particular stock or ETF is oversold just means it's gone down a lot. Use some other things to make sure you confirm what you might be seeing with that. When I think about this market, by the way, we're going to look at the Mindful Investor Live chart. There's just a couple charts here very quickly. And I just wanted to start it with the breadth conditions to see where we're at here. So here's the S&P making a closing high around 4,800, coming down to where we're at now below 4,400. And if you look at the breadth conditions, I have these four different cap tiers. We have the New York Stock Exchange, the broadest list of stocks we're looking at. We have large caps, mid caps, and small caps. Just using the S&P 500, the mid cap 400, the small cap 600. I've color coded two of these red because these are the two that have actually undercut their lows from December. So the NYSE, arguably is right there. I don't know if it's really violated it too much, but certainly dipped below that level. You can see that the small cap AD line yesterday actually dipped below it there as well. And you can see that overall, after making a lower high in both of those conditions, in both those situations, actually has rotated lower. The large cap and the mid cap AD lines, though, made higher highs November into January and still remaining above their December low. So when I'm looking at these and seeing the S&P break its swing lows from December, I'm seeing some of these AD lines breaking down as well, or very close to doing so. I'm seeing others that are holding up okay. And when I'm asked, is this the beginning of something much deeper, or is this just a buyable pullback and then we revert higher? This is one of those charts that I think could help you differentiate that. If things get worse from here, these AD lines most likely start violating support. We don't hold the December lows, we break right through them. So that might be an important chart to watch about now to see if that happens through the course of the rest of this week and then into next week and beyond. We need to take a quick break. We'll be back with today's guest, Chris Ciovacco. We'll see you in a minute. And welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close here at 4 p.m. Eastern as we break down the market activity using the power of stock charts, using the technical toolkit to try to quantify investor behavior. A couple comments before we get to today's guest, Chris Ciovacco. First off, we love to get your questions. We're going to do another mailbag segment a little later in today's show, and we'd love to answer your question on the air later in our next mailbag segment. You can reach us via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all of those questions. Hope to answer one of yours in our next mailbag segment. Also, go to StockChartsTV.com. That's our on-demand platform. All of our great guest appearances like Chris Ciovacco and many others, special events like The Pitch, our Market Outlook series earlier in this month, and so much more. Go to StockChartsTV.com to set up a free account. You can also, on your mobile device, just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Chris Ciovacco. Chris is the founder of Ciovacco Capital, based in the Atlanta area. Chris, you always bring a healthy long-term perspective. We need that more than ever. So welcome to the show today.
Happy to be here, David.
So you're starting us with a great long-term view. Certainly market conditions have gone from okay to negative to, desperate by a lot of measures. Start us with this chart using NASDAQ data. What is this telling you?
Well, first of all, it's a monthly chart. We know it's kind of dangerous to look at a monthly chart on January 24th. This is where the data came from, on the 24th. But the purpose is we have to ask, do we really believe, given everything we know today, that the NASDAQ is going to close at the lowest level relative to this breadth indicator in its entire history at the end of the month? If it doesn't, that means the NASDAQ is going to rally in the last 4 trading days of the month. We don't know if that's going to happen or not, but let's assume it doesn't. And we do print a very, very low number at the end of the month. If you take your cursor over to 1998, about halfway through that year is what it looks like. that low came on August 31st of that year. And we should also keep in mind when you have these very, very oversold type looks, in that case, between that low on August 31st and the peak in March of 2000, the S&P 500 rallied 60%. So I'm right there with you. I think we're kind of at a tipping point. This could go either way. So let's go to the next charts, and that can help us with that tipping point. If we look at these charts here, we have somewhat of two scenarios. You may remember 1995 shared a lot with 2021. Thus, the bullish scenario, better than expected, is on the left side of the screen. That's just depicting a very, very strong trend. The rolling over scenario is on the right side of the screen, which is the March 9th of 2020. And where that comes from is the breadth data that we've seen recently matched up between March 9th and January 25th, is what Dave mentioned. It could be relatively early. If you flip over to the next slide, you can see what happens next. So in one case, on the left side of the screen, the strong trend profile holds. And for the most part, we hang in with the moving averages. In that case, you had a 7% drawdown, a 10% drawdown intraday. And then from that low into year end, you rallied 18.21%. So that would kind of be our extreme bullish case. The map of extreme bearish is on the other side of the ledger. From the day that was similar to January 25th, using a breadth indicator, we experienced an additional drawdown of 18.54%. And I wholeheartedly agree that we're kind of in between right now. And these roadmaps can help us. If the chart in the middle is looking more and more like the chart on the right, we would be concerned. If it can kind of hang in there more like the chart on the left, then we have to keep an open mind about better than expected outcomes.
That's such a great illustration of the bull case versus the bear case. And you're exactly right. I mean, we're in agreement. It sort of feels like we're in the middle right now. So Chris, I mean, putting your money management hat on, I don't know if you have another hat, but, you know, thinking in terms of how you position, given that uncertainty, given that potential binary outcome, how do you position yourself through this sort of thing? Is this a time to, you know, be getting defensive and try to ride it out? Or, I mean, how would you sort of be positioned now, given that uncertainty?
I think it's a fantastic question. It's incremental. So what you're doing is you're looking at the charts and you're saying, we don't look as good as we did before. So thus some risk should be reduced. And you're basically trying to have your allocation of growth versus conservative be in line with the weight of the evidence. And if that weight of the evidence deteriorates, and you've got a lot of charts that can help you with that, then you incrementally move even further. And the thought process is pretty simple. Had you done that at the major peak in October of 2007 or the major peak in March of 2000, eventually you get all the way out if it gets really, really bad and the duration is long.
You know, when you're looking at the current environment, obviously it's been a fascinating stretch here, but certainly January so far has been fairly choppy and fairly frustrating. However, one sector has been an outlier, energy, which is up double digits while the rest of the market is sort of below zero and underwater for the year. What do you make of that? Do you see that as a sign of overall strength, meaning we should be leaning into something like energy, or is this a time to be lightening up, given the fact that it's overextended, quote unquote?
I feel like it's overextended in the short term, but here's what I would do: maybe take a chart of XLE divided by SPY, and then look at it on a very long-term basis. The 50-month moving average in that case is falling, and I'm not even saying you have to do it right now.
Yeah.
But the 50-month moving average is falling. The long-term trend is still down. That could be getting ready to change. We'll see tomorrow with the Fed. This is all about interest rates, and this is all about the Fed. Is XLE going to take off like a rocket tomorrow, or is it going to plunge like a stone and tech and growth are going to rebound? That's the to be determined. There is absolutely zero question that energy has broken out on a shorter term basis versus the S&P 500. And that needs to be respected, because if the long-term trend is going to flip, the short and intermediate has to flip first.
I love that, Chris. Anytime I even try to ask about something short-term, you give a proper answer, was to put your long-term hat on. And it's a great thought on energy. I'm going to take a look at that after the show. Chris, listen, we have to leave it there. It's so good to hear from you. Appreciate you sharing some thoughts with us. Stay safe down there in Atlanta. We'll talk to you again soon.
It's great to catch up. I appreciate the invite. Enjoy your show, Dave. Keep up the great work.
Thanks so much. That's Chris Ciovacco. Chris is the founder of Ciovacco Capital, based down in the Atlanta area. Hopefully you see what I have seen from getting to know Chris over the last couple of years. He does such a great job of thinking about things from a long-term perspective. And it's so easy to get drawn into what I call the flickering ticks and the short-term movements. Look at the long-term trends, particularly look at how the current market lines up with some of those historical periods. I jotted down thinking about some of those relationships he was relating to where we're at now, to some of those historical periods. Encourage you to very much do the same. We need to continue on with our next segment, answering your questions from the Final Bar mailbag. As a reminder, our email is thefinalbar@stockcharts.com. Keep your questions coming. We've heard from so many of you, and we're very appreciative of that. We look forward to hearing from those that have not written in. Do it now. Our first question: I'm puzzled by your weekly timing indicators. The most actionable one for me is the short-term indicator. I heard you say recently that it is based on something like the 25-day EMA. Why not choose the 21-day average, as that is what you and many other presenters often cite in your market analyses? Great question. And I do get a number of questions of this from people who are more short-term oriented and trading, minutes to hours to days, as opposed to months, which is where I tend to live a little more. So totally fine. And I would say, I think the most important thing you can do as an investor or as a trader is understand your time frame. What question are you trying to answer? What game are you actually trying to win? You and I might have a totally different investment horizon. As a result, the evidence we look at should be very different. What I would tell you, though, is if you are short-term oriented, don't neglect the longer-term chart. Some of the things like what Chris Ciovacco was just showing you, even if you're a short-term trader, that's the environment that a lot of the big money managers are living in. They're looking at secular trends. They're trying to trade multi-month, if not multi-year moves. And their capital is what's really going to drive the markets on a day-to-day basis in a lot of ways. So understanding those longer-term trends and what the institutions are using to make their decisions, I think, is important no matter what time frame you're on. Having said that, yeah, my short-term model is actually all based on weekly data. This is just looking at the current price versus the 5-week exponential moving average. It's not really like the 25-day, a little different. 5-week, when you're getting exponential averages, it's not as clean as you might think. Having said that, for me, the main indicator of short-term dynamics is the daily chart of the S&P 500. I have that short-term model as sort of a placeholder to make sure I think about the short-term trend relative to these longer-term models. But for me, the daily chart of the S&P is the main thing to look for. And I don't use the 21-day very often. I think Grayson Rose and others definitely do. I don't tend to look at that or the 100-day moving average. I look at the 50 and 200, pretty straightforward on daily charts. And that's my answer. Next question. You've talked about the long-term models. Another question on the model here, crossing above zero in June 2020, and the medium-term model crossing above zero in May of 2020, which is sort of back in this area. Can you comment to the times when they cross below zero? Also, for the week ending January 28th, it looks like the long term will be above zero, while the medium term will probably be below. Can you comment regarding this possibility? Yes. So I often have mentioned these periods just to show that the models have remained bullish for quite some time, right? So even with these Bible pullbacks, for me, the long-term and medium-term model have remained bullish, which has reminded me to stay positive. Thinking about what's different right now, my medium-term model turned bearish last week. And that's certainly a change for me. So this is, the first time since May 2020 that this model has turned bearish. It's been bearish a couple different times. One was a head fake here in August of 2019, a brief pullback before we reverted higher. The other two times were October of 2018 and March of 2018. The March, April, May 2018 really was more of a time correction. We didn't really sell off much further after that and eventually turned back positive and resumed the uptrend. The September, October 2018 was a tough one, though, because we continued lower for a couple months there and was certainly a period of price deterioration. The other time, obviously, would be February 2020 when it turned negative. So what concerns me about this model right now is we are similar conditions to some of the deeper drawdowns and either price and or time corrections. This is different, according to this model, than some of the briefer pullbacks that we've had in recent history. So it tells me to think of it a little more differently right now. Next question. When I look at the SPY from March to May, I see 3 dips with higher lows. I also see lower volume for each dip. It seems the same has occurred from November to January. Is there any significance in that pattern and in the fact that it seems to appear twice in the year? That's a great question. Let's bring up the chart here. So I'm looking at the SPY I don't have volume on here normally, but I will add it right here. I'll do it as an overlay, and we're going to clean this other stuff off just to try to have a nice clean look at what you're asking about. So you're basically saying, here's the SPY. Seeing March to May of last year, and you're seeing a higher move on lighter volume. I guess that's referring to. Also for the week ending, let's see, same firm from November to January. I'm not really seeing that, but maybe we're looking at different things. Oh, I think maybe this one here, right? We're seeing higher 3 dips with higher lows. I don't know if I'm necessarily seeing that with volume. Tell you what, if you send in that question, send me the chart you're looking at. I can take a look and see what's making sense. But in general, I would say this, volume, if you're looking at purely volume in general, what you would want to see is the volume based on the direction of the trend. In a bullish phase, you want to see the market moving higher on heavier volume. That just tends to indicate that there's more buying power on those up moves as opposed to selling pressure on the downside. You can color the volume, which just shows you the up or down days and what sort of things you're thinking. So maybe this is what you're referring to, which is the lighter volume on these dips. I don't know if I would necessarily draw any dramatic conclusion from that, to be honest with you. What I would tell you, one of the things that I do find meaningful is in most price pattern recognition. If you look at Edwards and McGee, which is sort of like the Bible of technical analysis, really pioneered the idea of price pattern recognition and flag patterns and coil patterns, symmetrical triangles, all those sorts of things, head and shoulders patterns. A classic definition of that, a classic interpretation is you want lighter volume during the course of the pattern and then a big volume move going out of the pattern. John Murphy talked a lot about that. In general, a price pattern tends to have lighter volume during the course of the pattern as things sort of consolidate, and then the market resolves one way or the other, and you see heavier volume. So I would maybe draw the conclusion of lighter volume through the course. You have the biggest volume here in November, and then lighter volume as we make new highs is not super encouraging. That's actually telling you more internal weakness. And also just the fact that the volume is more on the down days than the up days. I think that's more telling than anything else that you might be asking about. We have to wrap the show. Listen, keep the questions coming. We'll get to more of them in our next mailbag segment. We very much appreciate you sending your questions in. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Had a great discussion here with Chris Ciovacco, and I love to supplement some of that with a look on breadth. We talked in our market recap about some of the breadth conditions deteriorating. I think the question for most investors, including me, is how do we differentiate the beginning of something much deeper, as this being the first leg down versus this was it and the low from yesterday is the low. I think a chart like this could be one of those things to help you differentiate that. Breadth conditions are flat to negative, but not dramatically negative. I would argue the price action on the S&P is pretty weak, getting below the 200-day, getting below the December low, but the advanced decline lines really have not broadly confirmed that yet, particularly with the mid cap and the large cap breadth. I'd love to see if they would get below the December lows. That would give me a much higher conviction that deeper moves are in store. Second chart is the bullish percent index, sort of have a breadth theme to the charts today. The bullish percent index down to around 40%, which means less than half of the S&P members are in buy signal right now using the point and figure charts. Over half of them, 60% of them, are in a bearish pattern. And what's interesting is now this is only looking like one other observation. This is looking kind of like the May 2020 drop, which is a buyable dip, but that very quickly turned and went back above 50%. We stay below 50% much longer. This looks very different than these previous buyable dips, and it looks a lot more like one of the more destructive lows. If you extend that chart back to 2009, you'll see what I mean about some of those previous drawdown phases. Finally, how many stocks are above their 200-day moving average? About half, 54% of the S&P as of yesterday's close, remaining above their 200-day moving average. We'll update that for today's close a little later after the show, so keep an eye on that chart as it updates. Percent above the 50-day, it's about 1 in 3, only 33%, which means 2/3 of S&P members are already well below, or at least a little bit below, their 50-day moving average. If you look at where we're at and look to the left, you can see, as with many things we've talked about, this is similar to some of those previous buyable pullbacks along the way. What differentiates something like the February 2020 sell-off is we go much deeper. Down there, you had almost 0% of the S&P above their 50-day. It's still 1 in 3. Does that continue to deteriorate? That's a place I would be looking to see if we get some further downside deterioration. Folks, that is our show. Thank you so much for joining us every weekday after the close for the final bar. It's great to have you join us. Keep your questions coming. Our email is thefinalbar@stockcharts.com. Special thank you to Chris Ciovacco from Ciovacco Capital joining us from Atlanta. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.